officials in the Chinese city of Macau, often referred to as the gambling capital of the world, ordering that the town be shutting down all of its casinos for 2 weeks' time as the city continues to grapple with the outbreak. Casino operators like Wynn Resorts and Las Vegas Sands now bracing for impact here. And really, every other piece of the economy, too, splintered off from that entertainment sector, also watching this closely. Joining us now is Fundstrat Global Advisors Managing Partner, Head of Research, Tom Lee, back with us in studio. Good to see you again.
Yeah, good to see you guys.
Under all of this that we're watching play out, though, a lot has been made about what, not just the moves right now to shut down Macau, but really what the spillover effects here could be as investors continue to watch coronavirus cases spread, people staying at home, very nervous over there. What do you make of all this?
Well, I think, markets prices change because either the fundamentals will change or the risk premia, the perception of risk. We are in the view that the coronavirus should be affecting risk premia, meaning I would expect stocks to be weaker on this.
Yeah,
but
it's strange to see the rally Monday and Tuesday.
Yeah, but, market's smarter than any individual. So to me, this is signal. And, maybe the reality is that we've already priced in a corona event. So I don't know. I think it's actually a lot of signal today in terms of price move.
So taking a look at the different markets that have been impacted, though, oil continuing to get pummeled. It seems as if the value trap thesis is sort of still intact for a lot of these energy investors. If we strip away the coronavirus, though, and we're taking a look at the energy sector, what are your thoughts? Is this continuing to look like a value trap to you this year as well?
I think energy, in a way, is kind of caught up in a couple of currents. One is, of course, the GDP risk from China, and they're a huge commodity consumer. But I would also think if someone's going long Tesla, they're shorting, the energy ETF. So I think it's a convenient punching bag for an overweight Tesla thesis. So I think those combined effects are contributing to the misery. I think energy turns around later this year because it's historically one of the best groups to own if the PMIs recover to 50, and that's what we got yesterday was an ISM recovery.
Well, you talk about the ISM recovery. I know everyone's talking about Tesla, so we're going to dig more into that one in a little bit. But while you're talking about the ISM numbers that we got, you actually pointed out yesterday in a note the information that comes along with that is potentially a buying opportunity here for folks, too. When we look at the rebound in the ISM numbers, particularly you were looking at ISM exports and what happens when that rebounds above the 50 level, which would no longer show contraction when we're back above 50. And you looked at what happens when we do see that recovery. And interestingly, you point out in your note that a rebound in that number back into expansion territory or above 50 is traditionally seen as a buying opportunity when you look at what happens with earnings per share growth. And noting that in the 5 instances that's happened since 99, you've seen a boost of 18% in EPS growth. But what does that mean if the street's only really pricing in 10% EPS growth? Are you saying that this signals that we could be out of the woods?
That's right. I think, if I had to look at consensus, I think people think we're late cycle. Earnings were flat last year, and maybe we'll be lucky to squeeze out high single-digit, low double-digit earnings growth this year. But the ISM export number blasted to 53 from like a 47 rate. I mean, it's a massive turn. It's really interesting because the 5 other times it's happened, it's been accompanied by a big recovery in earnings, as you point out. So I think that makes sense. I think we've had a big inventory drawdown. A lot of growth slowed because of the trade war. Now that it's all turning, we could see 15% S&P earnings growth this year, and that would be on top of possibly PEs expanding. So maybe we're up 20% this year.
The big question mark there, too, though, would be in the short term with the coronavirus outbreaks. How would that impact? Because we just heard China potentially saying that they might not be able to meet the purchases that they promised the U.S. I know that doesn't necessarily correlate to manufacturing because of what we know in the inverse relationship between the U.S. and China. Generally, we'll be buying more of their things. But how might that impact things in the short term? Even though we see this short-term rebound in ISM, what happens if the coronavirus maybe lasts longer than a lot of people are expecting?
Yeah, I mean, I'd say the coronavirus is probably like one of these high amplitude but short-lived effects, meaning, we're already seeing the quarantines and people not leaving. It's going to kill retail, but it doesn't kill the full year because all of that stuff comes back. So I think the market is willing to look through it.
Got it.
I think the problem right now is high yield isn't rallying that much and the VIX is still showing a lot of fear. So I think that's why, to me, the equity market, it's a lot of signal, but it's hard for me to say that maybe the bottom's in.
Hey investors, Zack Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.